In this lesson, using the COT report to trade, the learning objective is you should know how to trade using the COT report. The COT, or Commitment of Traders report, can provide up-to-date information about trends by detailing the actual positioning of speculative and commercial traders in the futures market. As Forex is an over-the-counter market, the futures market is utilized as an alternative. What this means is you can't see the positions of Forex traders that trade just by the spot market, because as the market is over the counter and decentralized, there's no one place to look at all trades being done. So we have to use an alternative, which is the futures market. The Commodity Futures Trading Commission, or CFTC, publishes the Commitment of Traders Report (COT) every Friday around 2:30 p.m. Eastern Standard Time. The COT report contains a lot of useful information. However, the essence of the report is that it provides data that shows the net long or short positions for every available futures contract for both commercial and non-commercial traders. So this includes Forex pairs. Here are some terms you should be familiar with to decipher the report. Long means the total number of long contracts known by the CFTC. Short is the total number of short contracts known by the CFTC. Open interest is these are the contracts that haven't been delivered or exercised. Options being what we described in one of our very first lessons, being a form of trading. The form of trading where a person who has an option has the option to buy or sell a currency at a certain price. So if you have a lot of options opened in the past week for the price to go higher, let's say those options have been opened to buy, let's say, the euro from the euro to the US dollar at $1.50, €1 for $1.50, and the current price is $1.40. That means many people believe the price will go up. But for more in-depth explanation, you should go back and watch that first lesson. You should also know number of traders, which is the total number of traders who are required to report their options and futures contracts positions to the CFTC, and net position. This is the difference between those holding long contracts and those holding short contracts. So if the net position is positive, you know that there are more buyers in the market than sellers, and if the net position is negative, you know there are more sellers than buyers. Also, when I mean by required to report their option and futures contract positions to the CFTC, it means that they have a very large position. So this doesn't take into account retail traders, and so this gives you an insight into what banks and smart money, large institutions, hedge funds, etc. are doing. There are three main groups mentioned in the COT report. Commercial traders. Commercial traders are usually in the market to lock in gains for clients rather than hedge risks, and they tend to place trades in a direction opposite to the expected price direction. They are considered the most knowledgeable and are the most important group to watch. When I mean lock in gains, it means they are closing their position. Non-commercial traders. This data most often relates to large speculators, often large institutions, speculating in specific futures markets. Many speculators are known as hardcore trend followers, since they buy when the market is on an uptrend and sell when the market is on a downtrend. Large speculators are also big players in the futures market, since they hold huge accounts As a result, their trading activities can cause the market to move dramatically. They usually follow moving averages and hold their positions until the trend changes. And thirdly, you have a group of non-reportable traders. Non-reportable traders are traders who don't fall into either group. Most often, these are small speculators, and they are arguably less significant and do not frequently figure into COT report analysis. They are known to be anti-trend and are usually on the wrong side of the market. Because of that, they are typically less successful than hedgers and commercial traders. However, when they do follow the trend, they tend to be highly concentrated at market tops or bottoms. This is a real-world example of a COT report. As you can see, it lists non-commercial and commercial traders and what their current long positions are and their short positions. And you also have a group of non-reportable positions to the right. So how do you use the COT report? Understanding the different players in the report can offer clues about price movements. For instance, non-commercial traders are usually price speculators and trade in the direction of the anticipated price movement. If the net position is negative, speculators and commercial traders are net short. There are more short contracts than long ones, which indicates an overall bearish sentiment. When the net position is positive, traders are net long, which means an overall bullish sentiment. Going with the crowd can be a profitable trading principle at times, but it has periods when it works and times when it doesn't, like every trading period. When speculative money is very net short on a particular market, some good news that causes a small upward move can spark a rapid appreciation in price, as those who are short look to cover their position by buying back the market, forcing the price higher. Others then also cover their position, sending the price yet higher, and so on and so on. What I mean cover their position is when these large traders, let's say they're selling and the price goes up, because they take out a lot of money and they're borrowing, they can't afford to have big losses and be liquidated like many retail traders. They have to close their position. Otherwise, the people that let them borrow money would end up having a massive loss. In contrast, when speculators are heavily long, a piece of good news may not cause a spike, since everyone is already long, and there is relatively little extra money to flow into the market. When bad news emerges, if speculators are already heavily short, then the price may not move down by much. And bad news might not hit a market hard even when money managers are heavily net long, since longs are usually less keen to abandon their positions than shorts. Traders can also track the harmony in the positioning of commercial traders and speculators to confirm a trend. Both these classes of traders usually trade in opposite directions. This means that long commercial traders and short speculators should place trades in unison. Similarly, long speculators and short commercial traders need to place trades in unison. When they place trades in unison, the probability of the price moving with them becomes higher. And you would follow the trades of speculators. In conclusion, the goal of using this report is to follow the smart money. If you look at this report long enough, you'll start to notice concrete patterns. It is very useful to include in your weekly analysis and preparation for the upcoming week.